I don't think trading is 90% psychology because you can't build solid psychology on bad technicals. David Goggins, one of the most disciplined men on earth. If you put him in front of a trading screen, he's gonna have no idea what in the heck he is doing. Without having a solid system, risk management, technicals, and experience, psychology doesn't mean anything. I think that paper trading is a scam. If you're paper trading trying to learn a system, you're gonna get very confident using money that doesn't matter. No matter how many times you tell yourself that that money is real in your head, like, I'm gonna pretend this is real, I'm gonna treat this like it's real. All right, I've been on a simulator for 3 months, I think I'm ready to go in, I've made $100,000 in the sim, then what happens to 99 out of 100 traders? They come in and they get wiped. So for me, the only way to avoid that is a big problem that I see traders have is every single day they're going into the market and saying, all right, I just need to get it back to break even. I just need to make that money back that I lost. And that is a vicious cycle to go through and one that almost ends in more losses. It's very commonly talked about for people to have risk management and to have risk mitigation when they're in a losing streak. What's not talked about is how to deal with winning and how to not only keep winning, but how to keep and save what you've won. So when I'm on a hot streak, I will.
On the show, we've had a wide variety of guests that are in the profitable space. I've come to learn that it is the Wild West, but it's an opportunity for us that might not be here in 10 years. Looking back, 8 years ago, I didn't have that when I also started. I wish I did. So I want to kind of hear your thoughts. If you were to start again, how would you navigate yourself starting again as a new trader?
You know, this is something that I'm always told is controversial, but
Ladies and gents, welcome back to another episode. I'm joined by JDun. He's been generous enough to fly into Miami to make this happen. Bro, thank you very much for coming down. I think we're going to do a options masterclass, and we're going to have a lot of fun. I'm not too experienced in options, but seeing your journey, seeing your live logins, seeing the transparency you have, and also the way you speak to your audience with the motivation and just resilience, that message that you have, I think we're going to have a lot of fun today. So thank you for joining, bro.
thank you for having me. It's going to be a good one.
So I want to start off with this whole idea of the live logins and qualifying yourself, as we mentioned just now off camera. Not a lot of people do it, and a lot of people would just do anything rather than that. So I want to hear why that was important for you and why you continue to do so.
You know, I've been learning how to trade. I like to say that I have 8 years of trading experience, but that includes my learning part as well. Mm-hmm. I had a rough learning curve, as many traders do. And during that process, Umar Ashraf, someone that you know well, was one of my, I like to call mentors. And I saw him year after year posting his live login, showing that he was making, $500K, $1 million, $2 million a year trading. And that stuck with me. Like, that was something that I thought was cool, and it showed me that this can be done. So through my journey, mind you, I don't make millions a year trading. I've made as of now this year, I've made 2.2 million so far in my past, 8 years of learning and trading total. So, not making 50K a day.
Incredible nonetheless. You set out probably all the goals you had coming into it being a trader. That was probably a big one, being a millionaire trader.
And that was always my goal. When I first got into trading, when I was 20, I'm 28 now, I didn't look at it as I'm going to go in and I'm going to, make $1 million a day next year. I looked at it as I want to go in, I want to make $500 a day, I want to make $1,000 a day. I want freedom out of this. So in my process, getting back to the live logins, I scaled up slowly. I started with $5,000. I'd make money, I'd lose it. I'd make money, I'd lose it. And I wouldn't really make any progress. And it wasn't until probably 3 years in, give or take, that I found my edge, you could say. I've been full-time trading for 5 years. That doesn't mean I only trade, but I do it every single day. I wake up, I watch market open, New York session, and I aim to make money or to lose little bits of money. And back to the live login part, I found that, through my years of doing this up and down, that I saw a lot of people online that would post these $50,000 days, these $100,000 days, but there was never any real substance to it. It was, you would see it, and then that was it. There was no year to date, like, hey, this is how much I made this year. There was no, hey, this is me live logging into my broker to show you that this money is real. And I found that, at times, especially in my younger days, I would be very, I don't want to say envious, because I don't really believe in jealousy, but it was a little frustrating to see people post these massive days and make trading seem like it was easy, and that it was just, come buy this course or do this strategy and you're going to be a rich, millionaire trader. And I wanted to be a source of good for people that, if you work really hard at something for a really long time and you don't give up, results can be attainable. So to me, that was a big part of the live logins. Obviously it's, good having a trading brand, but also it shows, I think it offers a ray of hope for a lot of new traders that genuinely want to come in. They want to make money trading. They want to better their families' lives. They want to free up more time. And I just think that, we need more transparency, whether you're making $1 a day or you're making $100,000 a day. And that was my...
Beautiful. I'm glad there are people that are doing it in the FX realm, which I come from. There's a lot of hidden tricks that people can do with owning a brokerage, offshore, unregulated brokerages, renting a server, white labeling, all these kind of things that people can do. That's to the extremes, but also just down to just Photoshop, screenshots, out of context, as you said. One account might be good, one account might be bad, but you only show the good. Or these kind of things are all over the industry, but it seems like in options, it's a regulated thing, so you can't really do any of these tricks that the FX guys do.
Every options brokerage that I know of is heavily regulated. It's all regulated through the US, or, if you're on Interactive Brokers, it's available overseas and such, but it is also regulated. So it would be extremely hard, if not impossible, to, I guess, fudge a live login or fudge, results from a real brokerage. But that's not to say, you could get on Photoshop or whatever with screenshots. I don't know what skills people have, but it's possible. But with, real videos or real results that people, and, you mentioned FX, well, I'll live log into my broker and I'll show you I made $20 million. Well, a lot of that can be manipulated, so I've heard.
So the last big episode that you did was the man, the myth, the legend, Riz, and this was maybe 7-8 months ago. So you mentioned coming into 2024, you wanted to possibly transition into futures. How did that journey present this year?
So it started off okay. It wasn't very much. It was like $2,000-$3,000 trading futures. And I kind of came to the conclusion, I was like, why am I doing this? I'm a good options trader. Going into this year, I'd made $2 million doing so. And this year I'm up around 190. So I'll get into why that number is so low compared to the $2 million mark in a moment. But, I kind of came to myself and I was like, if it isn't broke, why am I trying to fix it? Part of me wanted to jump on the futures train because, you see everyone in the prop firms and you see it big across social media. And I'm not counting out that I'll never do it. Like, I might full-time switch to futures. I know a lot about futures, ES, MES, NQ, MNQ, and I know how they work. I watch NQ and ES every day when I'm trading, SPY and QQQ. I just personally don't execute on futures. And I found that with the edge that I have in options and with the edge that I have in trading in general, it's like if I start to feel like I lose that in options, or if I'm not willing to, deal with the stress anymore, sure, I might switch to futures and I might really give it my all long term. But I didn't feel that I was in the right headspace starting the year to pick up a whole new instrument and to go that route.
And if there was like a beginner trader or a new trader coming in and they were picking between options and futures, where there's a lot of guys on social media that are doing one or the other, now looking back and that you've had your hands in both for a bit, what would you say are the main pros and cons of either?
I think the pros of futures are you can get started cheaper if it's a good prop firm. I have a whole opinion on that we can go over later. But if it's through a good prop firm, you can get started pretty cheap and learn pretty cheap with minimal downside. Okay. It's much simpler. With ES, every tick up you make $50, tick down, lose $50. With MES, every tick up you make $5, lose $5, vice versa. NQ, it's every tick up you make $20, lose $20. And MNQ, I believe it's just a tenth of that. You make $2 every tick up and lose $2 every tick down. So super simple. Options, not simple. You have all the Greeks, the main ones being gamma. You have theta. You have delta. All of those serve their own purpose. You have expiration dates. You have strike prices. You have to know how those all work. And I always say, like, if you're wanting to trade options and you want to come in and take it seriously, like, you need to start with very little money. I have a lot of people that are like, hey, a lot of friends that are like, hey, man, like, I see you doing well with this trading thing. Like, I'd love to try it. I have $10,000. I want to trade options. And I'll just be like, no. Like, you're not bringing $10,000 to start trading options because you will lose it. Like, it's not even if you're going to lose it. Like, I'm 99.9% of people will lose the money they first start with trading options. And that's the reality. And I try to paint that picture very clear because I feel like a lot of people in the space don't. They're like, hey, trading, if you come learn from me or learn this, it's going to be super easy and you're going to make a bunch of money. It's all horseshit.
Why do you think the risk of ruin or risk of blowing an account is much higher in options compared to others. So out of the dozens and dozens of prop firms that exist in the whole space, who can we really trust? Whether they use slippage, whether they use types of drawdown, unrealistic trading conditions, every single prop firm has hidden tricks. So after thorough research and speaking to a lot of traders, Alpha Capital is definitely the best prop firm in the space. So apart from their no commissions, low spread, no slippage, great reputation, never denying a payout, because you are a Titans of Tomorrow viewer, you get a special discount on every evaluation just using the link or using the code TOT for Titans of Tomorrow.
Compared to equities and future, because with options, you're trading off premium price. So, say you buy Apple calls, right, which is an option contract for beginners, and Apple's at $100. Well, if Apple moves up, $2 or $3, your option contracts, you might double or triple your money depending on your expiration date, which sounds great. You're like, I could double my money or triple my money in, a day? Absolutely you can. But how about if Apple, that same underlying stock, moves in the opposite direction? You could lose 100% of your investment in a matter of minutes, hours, days. Versus futures and equity, your risk is pretty defined. So, if you're trading ES and you go long and it goes against you, if it moves, 1, 2, 3, 4, 5 points, whatever it is, you're going to watch, your P&L draw down $50 every tick. And it's pretty easy to define that.
Yep.
When you're in an option contract that might lose 50% of its value in 2 minutes, which is dramatic, I might add. But it's possible. If you're trading 0 days to expiration, you trade same day expiration, it's extremely possible. It just offers, you can't trade options on leverage, but with the amount of volatility that option contracts have, you might as well be trading leverage, So there's a lot of gain. If you are disciplined, if you know what you're doing, you can make 20, 30, 40, 50, 100% in an hour of work in a day with options, which is an incredible return. But with that incredible return also comes the risk of that downside too, and people like to leave that out a lot.
So would you say, therefore, options trading, well, people say in general, trading can be gambling, and all that depends obviously on the behavior of the individual. But would you say options can be more like gambling because of this huge swings in potential gain and loss, and how fast you can have that huge gain or loss?
In a sense, yes. I think it brings out a gambling mentality in more people. Though my opinion on gambling and trading is interesting, because people always say, trading is gambling. And my response is, well, anything that you put your money and time to me is gambling. You go to college and get a $100,000 education. Well, you just gambled $100,000 in 4 years of your time. You start a business with $20,000. Well, you realize the statistics of business are the 80% minimum fail within 5 years.
Yep.
So you're gambling 5 years of your life and likely tens of thousands of dollars to start that business. So I think that anything that involves your time and money is considered a gamble. It's just a matter of what edge you have and how hard you're willing to work.
I think the key word you said there was edge. A lot of people say that, I'm not gambling, I'm trading because I have a strategy. And my immediate response to that is that, well, the people that go to the casino also have a strategy, whether it's like, I'm only going to pick red on the roulette wheel, I'm only going to pick even numbers, I'm going to pick the birthday of my loved ones, whatever it is, that's a strategy.
Yeah.
But that's not enough. So even if in trading you have a strategy, it still can be gambling. I think the edge is important. It's if you have that proven edge through your data, no matter the highs and lows in the short term, you will always converge towards your data. And that's what the casino does. They, in the roulette wheel, they have the 2 in their favor. So even though it looks 50-50, that 2 in their favor skews it mathematically in their favor over a large sample size. They will always make money. The house always wins, as they say. So I want to get into what you were just briefly saying off camera now, which was kind of like the history of options and how it was not meant to be a traded asset. It was rather designed for hedging, and now it's become something else. Just a brief reference for the audience, because at least from our side of the world, which is FX, which is the biggest thing in Europe and elsewhere, we don't really hear too much about options.
So it's very important to know this too for any aspiring options traders, and I believe for any traders in general. So options were not created as an instrument for, call them degens, for people to come in, degenerately gamble on. That's not why they were created. They were created to be a hedge for larger positions and specifically for market makers. So in layman's terms, in very simple terms, say that you are a shareholder of Meta and you own Meta at a strike price, or your equity price is $200 in general. You bought Meta at $200 and you own at least 100 shares. So you got a decent sized position. Well, if you don't plan on selling those shares anytime soon, or if you have a set price that you're willing to sell those shares, you could go and you could sell options. Now, a lot of times options traders don't even know that as a trader in the stock market, you can sell these things. It requires a much bigger an account, and it also requires margin. So as a holder of Meta, you own 100 shares of Meta, just for example, at $200 a share. You can go and you can sell, say, the 225 calls on Meta. So strike price of 225. Now, say that your expiration date is a week out. Now, if you own those 100 shares, and if Meta goes to that 225 area or above, you're going to have to sell your shares at 225. You're going to have to execute those shares and sell them off. You still make money. Not as much as you might have made holding them, but you will make money on it. On the flip side, if you're selling those covered calls and Meta goes down, you're going to take that premium that you initially sold, you're going to keep that, and the option buyer, whoever bought those calls from you, will end up with nothing because they expire worthless. So you keep your shares, you keep the premium. Now, in simple terms, what that means is that you get to hold your shares, or market makers get to hold their shares. Oftentimes they have much more than 100, hundreds of thousands for some of these exchanges and traders. And they get to keep that premium, making their average price lower, even though their stock stays the same. If they're collecting $1,000 a week on selling premium, over time, while Meta consolidates, goes up and down and doesn't really move, they're making money just holding those shares. It's almost like you have a dividend in the stock without actually having a dividend. It's paying you, of course, unless it goes up, then you have to sell your shares and lose that long-term potential. That's why options were made, was to help people hedge and as an instrument to use inside the market. They weren't made to trade on and take the difference in premium, which is how I trade and how a lot of other good option traders trade, but that's not how they were designed to be used.
Okay. So when it comes to actually now trading them, actually taking positions and so forth, what is your process in terms of like a top-down analysis, technical-wise? What would you define your strategy as?
So it's interesting because I've never watched an ICT video. I'm sure you know who that is.
Of course,
He's
yes.
big in FX and futures and even options. But how I trade is applicable. I'm sure I use volume price analysis. I trade volume and I use candlesticks. Now, I've never watched a full ICT video, but I've seen bits and pieces of clips on YouTube and Twitter. You just can't get away from it these days. And a lot of the concepts that he teaches, I use just with different names, like impulse candles, areas of liquidity, supply and demand. Like I use all of these things. I just have a very simple approach to it. I trade in the 5-minute chart. I trade in the 1-minute chart. I find my levels in the daily and the hourly. And I don't swing trade much. I will on occasion, in a video or big companies, I'll buy dips on companies that I like. That's boring. We won't get into that. But as far as day trading goes, I wait for confirmation on the 5-minute chart. I'll find my levels on the hourly and the daily. I look for impulse candles. ICD calls them fair value gaps. I call them areas of confluence, in between a large candle and the 5-minute. We retest to make that lower high or higher low, depending on the trend. I'll take an entry. And the biggest part of my system, I like to say, is not some secret strategy. I think that everyone has a strategy, whether they make it super complex or super simple. And my edge comes from defining risk and choosing discipline over dopamine. So It sounds very simple, but if I can go into every trade, I can identify an area of interest for myself. And if I can define my risk, say 40 cents, if I can find a good area to enter, define my risk to say 40 cents, and I can also define my take profit then being 2 or 3 times that for my R multiple, that's how I trade. I don't look for any super complex entries. I like to keep my risk to a minimum. I do lose trades. I lose quite a bit of trades, as a matter of fact. But my winners are always bigger than my losers. And that's how I like to define my edge, is a lot of traders, I think, come in, they learn a strategy no matter what it is. But then almost always they end up choosing that dopamine over discipline. They're disciplined for a while. They're good with their entries. They manage their risk. And then they let the gambler side get to them. And then they let the itch to trade get to them. They let one loser, go past their stop and keep running and keep running and keep running until that same loser knocks out the last week or 2 weeks or 3 weeks of their wins. So after 8 years of doing this and learning myself and doing that myself many times, it just got to a point where the simpler I kept my trading, the more money I made and the less money I lost. And so if I had to put my strategy into words, using volume price analysis, reading candlesticks and volume together and executing with risk management, that would be it.
So this comment of like how what you do looks similar to ICT, I'm not finding a surprising statement. And in fact, it's something I've been thinking about a lot lately, which is if you have that typical head and shoulder trader, he's doing a simplified version of a Wyckoff theory distribution. And that Wyckoff theory distribution is very similar to one of the ICT models, I forget which one, which is very similar to other types of traders. So we are all painting the same price action with our own definitions.
Yes.
So with that being said, and everyone will have their own way of labeling, certain people say supply zone, some people say order blocks, some X, Y, Z. So rather than the labeling game, I want to hear your thoughts on like what's the most important things in terms of common denominators or key drivers of the markets. As you mentioned, you use liquidity, order flow and things like this. So what are the things that you really look out for that are not really part of a strategy or school of thought, rather just important in price action?
To me, I think the most important thing is volume and for how I trade. So when I'm looking at a draw into liquidity or a move into my demand zone or supply zone, whatever it may be, I need to make sure that the move is supported by volume. Now, a big driving factor for that was I've read the volume price analysis by Anna Cooling multiple times. She talks a lot about Waqar in there and his distribution theories and all that good stuff. And I've found that a lot of my best trades come from either A, finding an anomaly in volume where price is moving one way, volume is going down, which shows like, hey, it might be moving up or down, vice versa, but the move is synthetic. It's not real. It's likely to reverse. So when I'm finding lower highs or higher lows, and I'm looking for that that sweet spot to enter with good risk management, volume is what helps me do that. Otherwise, I found myself a lot in the past, guessing like, oh, this looks like it could be a lower high when we move down, move a little back up, move down a little back up. I'll try to enter on that next leg up or that next spot up, you could say, and then it would keep going against me. By incorporating volume, I still lose sometimes. No setup is 100%. But what I found is that if I can read those 5-minute volume bars and those 1-minute volume bars well, oftentimes when we get to that lower high spot or that higher low spot, it will confirm and will keep going the direction that I think it will. So, and I always like to say that with a grain of salt because there's no 100% strategy. But by incorporating volume to just reading price, it's amplified my win rate massively.
So when it comes to volume, I'm more thinking of it as liquidity in terms of orders coming in and out. Am I correct in saying so? It's the in live or real time intent in the market.
Yeah, and the amount, not only the amount of participants participating in the move, but how aggressive they are. So if you have very aggressive buyers, your buying volume is going to be up while price is going up. If you have non-aggressive buyers, price might be going up, but your volume is going to be low, which shows me like, hey, price might be going up, but this isn't an aggressive move that is likely to continue.
So let's say you see an example where price is moving very fast, let's say up, and the buyer's volume is very low. What would you deduce from that?
I would likely say that if we can, so I never confirm with only one candle.
Okay.
But in short answer, I would say the move is likely to reverse. In long answer, if we're going up on very low volume, I would say, hey, this move is likely to reverse, but I'm going to wait for confirmation before I take a trade. So say we're going up we're going up, but buying is not aggressive.
Yep.
We finish that 5-minute candle. I almost always trade in the 5-minute chart. On the next candle, if we can see, I'm very, I like to broad show with my hands on a whiteboard.
I'm following with your words.
So if candle A on the 5-minute is here, went up, low volume, I'm going to watch candle B here. If we can make a lower high on this candle, have some non-aggressive buying or some aggressive selling come in, I'm likely going to enter on that third candle and have my stop loss as the high of the first candle, because I know then if we buy back up, we might have had more buyers step in. Maybe they were more aggressive than I thought. And therefore, if we pass that first candle's high, my thesis wasn't right. We're continuing higher. A lot of times you'll end up seeing, if you see that move up on a low volume, that aggressive selling on the second will continue that trend down on the third.
The reason I asked that question of like the divergence between price action and volume is because I can imagine if that's happening in a liquidity pool. Now, my definition of liquidity pool might be different, but just to define it, is like areas that you see in price action on the left. So let's say I saw a very equal high as kind of a resistance level. I know there's a lot of stops above there because people like to sell on that exhaustion area. So if price just temporarily taps up, grabs those stop losses and volume, and then shoots down, I'll see that as a form of liquidity run. So if I'm imagining, if you see that price action signature and then the volume supports that push up was low intent, would that be a further confirmation of a real liquidity grab?
Yep, absolutely.
Okay.
So
So in that case, in FX, we don't have that. So when I say liquidity, I can only do predictive liquidity. What I think people would enter on, what I think stop losses could be, what I think would attract people to get in. For example, a breakout of a range. People like to break test continuation. So these kind of things, but it's all upon it's speculation. Whereas in options, you have the blessing of also confirming it with volume. So I want to hear your thoughts on how you peg predictive liquidity, just areas on the left, to what you see in real time and how you kind of combine it together to have further confirmations than the FX guys may.
Sure. And I want to add too that for any futures traders out there, when you're watching SPY, so when I have traded futures or the people that I know that routinely trade futures, everything you're seeing with volume and price on SPY is applicable to ES. So I would use the same concepts executing on ES that I do trading SPY. Now, as far as predictive liquidity goes, I assume you're saying that it comes up into the area and kind of predict that's there and execute on when it goes up. You don't have to, wait for that next confirmation.
No, it would be more like I know that a lot of stop losses are upon just a very clear resistance level. If price shoots up, you'll get a lot of stop losses out. So then, of course, after that, I would have to wait for a rejection to know it's not a breakout and a push out. Rather, usually, let's say, an M5 break of structure or some sort of people use doji candles or head and shoulder, whatever it may be, but some form of rejection after seeing a liquidity run to confirm it. Whereas you can do price action confirmations, which I'm gathering you do, but also you can support it further with volume. I want to hear how you actually tie in the volume to just what you see in price action.
Okay, so yeah, it's similar to what I said earlier. So say in FX where you don't have that those volume bars, correct?
Exactly. Yeah.
So
we have them, but I don't think anybody really believes in them, or hope people don't believe in them, because the volume you're seeing is from the price feed you have, and the price feed you have is from one brokerage. So that brokerage is a small sample size, and I don't think the big players are utilizing that broker anyway. So it's very misrepresentative. Yeah.
Interesting. So I guess you could say that, an FX union might come up and they look for the doji candle, they look for the, the bullish or the bearish hammer,
Yes.
whatever it may be.
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it. And probably you'll be using it for years to come.
I honestly, in stocks, options, and futures, I really don't use candlestick patterns. Now, I will use them, but I'll use them mostly for stop losses. Say, you come up to that resistance zone or liquidity zone, and we have a bearish doji, say, for everyone listening. And the top of that wick, you come up here, run stop losses, you'd assume move back down. Now, I also don't trade breakouts. I wanted to add that in earlier. I am not a breakout trader. I found that I've won breakout trades, but I lose more often than I win. They're stressful, not something that I'm interested in. I prefer break and retest, which we'll get into in a moment. I'm sure you guys are very familiar with that in FX. But how I would use volume is, especially in a trend reversal, a golden rule that I have is if you have that bearish doji at the top or that reversal candle, I always want a second aggressive candle, so another red candle, say if we're reversing to a downtrend, with higher volume than the previous 5-minute candle. If we get 2 reversal candles in a row, oftentimes I've found, as I said earlier, that third candle will continue down in that direction, or in the third, fourth, and fifth, we won't make another high in that range and we'll continue moving down. Now, in that instance, if we have that higher volume on the second candle, we continue on that trend. I'll set the stop above first candle. I'll have the stop of my trade as the first candle, and I'll look to ride that down to either A, low of day, B, a key level like pre-market low, or C, say we have 30 cents between our entry and our stop, at least 60 cents down, 90 cents down, et cetera, because at heart, I'm an R multiple trader.
Okay.
So if I can define my risk to 30 cents, I want 60 to 90 cents worth of profit, right? Or first trim, say at 60 cents, set stops to break even, let my trade ride. But I don't look at, a lot of options traders or futures traders are like, oh, I'm going to set my stop to, 15% or to 2 points, whatever it may be. I look at it as, all right, how much is my risk here? All right, double, triple that, set stops to break even, and let the trade ride as far as I can.
So with that, is there a form of partials you take? It looks like you do a 1 to 3 is your main target, and then a runner after that.
That's ideal. It doesn't always go that way. I at least like to get my first trim at like 2R, say. So if I'm risking 30 cents, trim at 60 cents.
Okay.
At an absolute minimum, anything below 2R just doesn't make a lot of sense for traders, long term at least. You might make money right away,
Yes.
Taking early trims, but over time, you have to have bigger wins than losses. And that's true in FX, it's true in options, it's true in futures. And that's why, not trying to veer off topic, but one of my biggest frustrations with traders is people that say, see green, take green, and green is green, man. Just take your profit when you see it.
Yeah.
And the problem with that is, it's great. I get it. You want to post it on your Instagram story. You want to show your friends that you made money, but you see green, take green once. You see green, take green twice. You take profit when it's small green a third time. What happens is that, on that third, fourth, fifth, sixth trade, that big loss comes in and it wipes out all those see green, take green days.
Yep.
And it also makes it about the money. We don't want to trade for the money. We want to trade for the principle. What is your system? What is your edge? Did you define your risk on that trade and then have a 2, 3, 4R multiple? No, you traded because you wanted to be green and because you wanted to stroke your ego. And that never ends well long term. You might make money for a week doing it. You might make money for a month doing it. But you're not going to make money long term doing it. And that's not my opinion, that's statistics.
Yeah, I mean, it's back to that casino analogy where you'll have a guy that comes in the casino, makes $1 million. You also have a guy that maybe rarely comes in, loses $1 million, but that doesn't make or break the casino. The edge does, and letting time play out towards that data. So these ideas of just take a profit. If you got something, take it early. If you've never seen that kind of money in your life, well, take it. Well, yeah, sure, but the moment you start to deviate away from your plan, you started a domino effect, and that might just mess up your whole system, and you might lose your edge without knowing it. So yeah, I want to echo that. Getting into the trading system itself. So it looks like you're utilizing momentum of the session or momentum of the moment through liquidity, and then you confirm it with the volume you see. Are you doing something similar to exit? So when you're seeing lack of intent or certain counter liquidity pools, how are you timing your exit, or is it just on an R multiple?
So it's mostly on R multiple.
Okay.
But there is times where you'll notice hey, it looks like a reversal is coming, volume is drying up, price isn't moving, where I'll say, if I'm either A, if I'm green, I'll just take the rest of my money off the table, or B, if I'm slightly red, I'll just take it off and minimize risk. So it's mostly done, my system mostly relies on R multiple, on following my price targets and my stop losses, but there is times where I'm not liking how price is looking, I don't like how volume's drying up, I don't like the direction volume's going in if it's going against me, then I'll just cut the trade and either A, take profit earlier than I expected, or B, take my loss and move on.
Okay. So earlier on in the episode, you mentioned that you only made 190K. And although that is a huge amount of money, you were referencing it to the year before where you made 10x that, it seems. So I want to, discuss what happened this year and maybe why it's not going towards the plan that you maybe would have had.
Yeah, so it's interesting because last year I made 842,000, which is incredible. In my eyes, it's incredible for trading. I was really proud of that. But something that really messed me up at the start of the year is I was up 930.
Okay.
In the last, say, month or month and a half of the year, I ended up losing like 80 grand.
Chasing the million, I guess?
Chasing the million, yep.
Yeah.
I was trying to go for that million, so I could, I'm going to live vlog and I'm going to show social media and everyone that I made $1 million trading this year, and I blew it. I not blew it, but I didn't have a good end of the year. Mm-hmm. And so I kind of went into that year with that timidness. Okay. And I was afraid, I don't want to say afraid, but I wasn't as risk averse. I wasn't willing to put on as much risk as I was the previous year. So I started out really slow. And up until this last month, I had my best month all year. I made 41 grand, just under 41 grand. Going, I guess, at the end of today's Friday. So in the past 4 weeks, I made 41 grand, which for me is an incredible month or incredible, month span. Prior to this last month, I was only up 150 because I haven't put on a lot of risk this year. Now, it's all perspective because I look at it, it's like, I trade for an hour or two a day and I'm up almost 200 grand on the year. Like that's, something I think a lot of people would kill for.
Yep.
Now it's a little frustrating in a sense because, last year was 4 times bigger. Now, granted, this year is not over. We still have the rest of Q3 and Q4. But, something that I did was I didn't quite have the confidence after losing a portion of my profits this last year. So I went in this year and I was like, you know what? I'm going to keep basically most of my risk off the table. I'm going to only take A+ setups. I'm going to use way less size. And when I feel I've earned the right to size back up, I will. This last month, I felt I'd earned the right to size back up, and I have slowly. I don't know what else the rest of the year is going to entail. Something I like to, say as a trader with 8 years of experience is just because I've had profitable years in the last few years trading doesn't guarantee me to be profitable this year. I come in like I'm humble. Like I know that if I F up, I could end this year red. I have a nice cushion, 190,000, but that doesn't mean that I'm just going to keep making money the rest of the year. And that's something that's not talked about is you don't just become a profitable trader and trading becomes easy and you make millions of dollars and you live the fairy tale life. That's not what happens. So
I think the word is confirmational bias, where you have somebody, let's say, shooting a basketball and they get 5 in a row, and then the reality, let's say, rolling a dice, and you get the number you want 5 times in a row. The odds of the next roll or the next throw into the hoop being in your favor is not influenced by previous events. It's an independent event. So when it comes to trading, these are all logical statements like, okay, just because you had a losing period doesn't mean the next trade has to be a loss, or just because you had a winning period doesn't mean the next trade has to be a win. These are all things easily said on a podcast or read in a book, but in reality, facing the emotions that you had at the time, how did you dig yourself out of the hole? And again, with 8 years of experience and these things that you probably are well versed in, actually facing it in reality, how was that journey to get yourself out of the hole, which you have, it seems like now?
Dude, it's hard, man. Like it's getting your confidence back in full is really tough, especially in the beginning. And something that I preach to a lot of my friends and fellow traders that I speak with is that it all kind of starts in your daily life. Obviously your trading is important and, how you position size yourself is important. I always recommend that if you're in a, mental drawdown or a capital drawdown or you're on a losing streak, you have to size down. Now, something else that you have to do in that process is after the trading day is done, you got to do something in your daily life to better your trading. That might be journaling every trade, which I think everyone should do. It might be, spending an extra 20 minutes prior to market open, looking at your charts, marking out your levels. It might even be dialing in your morning routine. Something that I do is I don't check my phone every day for like 30 minutes when I wake up. When I do that, my mental health, 100 times better in the morning. I go into my trading day 100 times more focused. And for me, it took a lot of internal work and a lot of just discipline dialing to really, even just this last month, getting my full confidence back. Getting my edge and my system completely back. Now, mind you, again, it's been a decent year, but I think that the problem that people run into a lot is they go into that drawdown. They might lose a few trades in a row. A big problem that I see traders have is, say they're down $10,000 or $20,000 or $30,000. Every single day they're going into the market and saying, all right, I just need to get it back to break even. I just need to make that money back that I lost. And that is a vicious cycle to go through and one that almost ends in more losses. Instead, I think people are better off, and I've found myself better off, of thinking, you know what? That $20,000 that I lost was part of my education. But it's only part of my education, and it only makes me better if I actually learn from it, and I don't repeat those same mistakes again. So that's something I did with, losing that $80,000 at the end of last year. So I thought to myself, you know what? That was education. That was part of, my humbling experience, my learning curve. I'm not going to let those same mistakes happen. And that's something that I've done this year is I haven't set a money goal. Last year I tried to get to the million.
Yeah.
I didn't get there. So this year people are like, JDun, how much you want to make this year? What do you want to make? And I'm like, I just want to follow my system. And if I do that, I'll make money. That's what I've proven to myself. If I don't follow my system, if I start focusing on the money, if I start focusing on all the things that I know haven't found me success in the past, I'm not going to make money. So that's been my mindset this year is I've taken profit targets out of it. I've taken daily goals out of it. And I've solely focused on system, risk management, and earning my size.
I'm liking this topic, and I want to take it towards prop firms. So a lot of people in backtesting are like, backtesting ninjas. They'll make millions of percents in the backtesting arena. And then they'll maybe even go into the live market with a small account and be able to flip it or, see some level of performance. The moment you go to a prop firm account and you have a 100K account, and that's money you've never seen before. And then you start doing the maths on each trade. 1 to 3 would be this, and a 1 to 5 I could buy this car, and la la la. And that's where everything goes wrong. So not necessarily the percentage or the gain that's the issue, it's the money attached to it. And that's something that you experienced and have addressed. So I want to kind of hear your thoughts on, as you mentioned, the prop firms and kind of how, if you believe in it, don't believe it, and how you think people should navigate it.
I think in theory, prop firms are a great idea. I think that giving traders a chance to learn with less upfront capital, a chance for good traders that know what they're doing to get funded that might not have the starting capital they need is great. Obviously, I think that a lot of the the prop firms that are ran by predatory individuals or predatory practices don't do anything positive for traders. I also think that sometimes these prop firms set unrealistic goals for traders. And, think of it like this. So you have a 100K funded account, and, you think that once you do that, you're going to, quit your job and make a bunch of money. Well, think about that in percentages. The average return on the S&P is like 10% a year, give or take. So if you have a $100,000 account, trading futures, you're going to need to make of that account, 10, 20, 30, 40, 50% just to outperform the normal market. And with futures, I think that's kind of tough, especially with a funded account that has all these strict rules. And if you trade within minutes of data, and if you have, one extra point of drawdown, all these different stipulations, blank, you're failed, restart. That's really tough. The best thing that I think traders can do if you're on a prop firm is get in, buy your challenge, whatever it is, get funded. And as you are making money, take every dollar you make out and put it into your own account, fund yourself. And so you keep 100% of your money, you don't have the drawdown rules, and you can really build not using someone else's capital or building someone else's dream, per se. That's my thoughts on them. I think they're a very good instrument for people if they're ran properly. I think the idea behind them is pretty neat. It's something that's new. We haven't really seen that in the past. They've really blown up in the past few years. Yep. But I think that, not going to name any names of prop firms, but I've seen some that have, been proven to, slip traders,
Yep.
widen the spreads, fail traders for no reason. All those things, that's not good for anybody except the prop firm owner. So, in theory, I think they can be great for traders if they're ran correctly. But obviously, if they're not, which many of them, unfortunately, I believe aren't, it can be very predatory and a very negative thing for the trading space.
So on the show, we've had a wide variety of guests that are in the prop firm space. Certain guests that have made $1 million in payouts. I think one has made $2 million. We've had the number 1 ranked FTMO trader. We've also had the most banned trader, a guy that's just made too much money and keeps getting banned. So with all these kind of things, I've come to learn that it is the Wild West. And my overall assessment, however, is that it is the Wild West, but it's an opportunity for us that might not be here in 10 years, might not stay around for a while, but right now it's okay. And you can kind of milk it. It's a little bit inconvenient to get banned. It's a little bit inconvenient when they widen the spreads. It's unfair and whatever. But I think of it as the risk reward of your challenge fees to what you make. And I think looking back 8 years ago when I didn't have that, when I also started, I wish I did. So I want to kind of hear your thoughts if you were to start again. I know it's the Wild West and there is definitely some disadvantages. How would you navigate yourself starting again as a new trader, like a lot of the audience may be?
I think if I had to restart from scratch, one of the things, with the knowledge I have now, one of the things that I would do is I would still fund myself. I don't see any issue with people getting funded. I think prop firms are cool. And like you said, Wild West, and you've seen a lot of success in them, which is great. People do succeed using them, which I think should be said. I still like the idea of building up myself using my own capital, but I would definitely look into more instruments such as futures. That wasn't really, they were around 8 years ago, obviously, but options was just kind of the thing. A lot of it was like penny stocks. You'd find a lot of penny stock stuff on YouTube and on the courses back in the day. I traded those for a while, don't trade them anymore. But one thing I would do too is I would really double down on finding a system first, because I came into it, I just want to make money. I want to make $500 a day. I want to make $1,000 a day. I didn't really focus on the word edge or the word system or the word risk management. That wasn't even really in my vocabulary to start. So I might try. I mean, I can't say that I can't go back 8 years ago, but 20-year-old me might have tried a prop firm, might have tried to see if I could get $100,000 from someone else, like thinking of a beginner trader. That sounds awesome. Like, you know, I only started with like $5,000. So like I think back and I'm like, damn, if I could have 100K or 200K or $1 million in funding, that would be incredible. But my thing with prop firms, and if I were to get into them, is I would like to have a path to being an actual funded trader, like a real prop firm, you know, real life prop firms, you know, in, you know, Dubai or in New York, or, you know, they're all around the world. They get traders on, they might test them on simulated capital, but they fund them with real money. And I think that is like the golden ticket of having real money funding from a real firm, that you don't have all these, you know, all these software stipulations of, you know, these super tight stops and all these other rules, which I get for these businesses they have to have. I don't knock them for that if they're fair. But I think for me, the biggest thing would be developing an edge, finding a system, having confidence in my system, and then building that up faster than I did.
A brief moments ago, you were talking about risk and how if you go through a losing period or you're down, is to then size down to then, you know, handle the emotions and so forth. I think I heard, maybe it was Ray Dalio said something, it was an ad that I saw of his, and it was to the effect of, if you lose 50% of your account, you have to get 100% gain to get back to break even, meaning like 50% losses, you got to double it. It becomes harder to risk down whilst you're in the hole. So I want to kind of hear your thoughts on risk management when you're in a losing period, but also in a winning period if you're in a hot streak, or do you just standardize risk throughout?
You know, I'm really glad you said that. I think that it's very commonly talked about for people to have risk management and to have risk, you know, mitigation when they're in a losing streak. What's not talked about is how to deal with winning, and how to not only keep winning, but how to keep and save what you've won. So when I'm on a hot streak, I will continue to slowly, keyword slowly, size up. But after years of doing this and having times where I was hot and then quickly I was not and I lost it, I found that, you know, for me, one of the things that I have to do is I have to learn to walk away and to limit my trades, especially when I'm green. Now, I have a loss limit. It's very simple. You know, if I lose 2 trades in a day, I'm done. That's a rule I've set for myself. If I take 1 trade lose, 2nd trade lose, I just walk away for the day. If I go back the next day and lose 2 trades in a day, which hasn't happened for a while, but it has happened many times in the past, again, I size down, I walk away for the day. Now, on the flip side, if I am winning, like I'm just on a winning streak, I'm crushing it, and I win a trade for the day, oftentimes if I take another trade, I'm not going to give back all those profits. I hate going green to red. Like it's just, even 8 years later, it drives me nuts. It hurts my, you know, my trading psyche. It hurts my confidence. Not something that I'm almost ever willing to do. So if I'm in a hot streak and I win a trade, I'm only going to try to give back, say, 50% of that on the next trade I take. If I'm up $3,000 for the week and it's a Thursday, on that Friday, I'm only going to risk, say $1,000, for example. I always take into account what my year-to-date is, what my quarter-to-date is, what my month-to-date is, what my week-to-date is, and how much I'm up, and how much I'm going to risk is often predicated on that. And that's what makes the beginning of the year so tough for me too, I think, is that you don't really have a cushion. You can think to last year, but you don't want to dip into last year's money you made. You already made it and withdrew it. So starting the year, you don't really have a cushion, but as the year goes on, and, you know, granted, you're managing a risk, you're following your system, you're making money, you get that cushion to lean back on that you can kind of leverage the risk you put on. Does that make sense?
So you're utilizing your buffer to then kind of slowly increase your rate of return.
Yes.
So I had this exact conversation with Umar, and you mentioned that you look up to him and learn from him. So my position is I like to have a linear growth. And I see the virtue in trying to get at this exponential growth faster towards the end of the year. And the way I kind of achieve that is, instead of modifying my risk, I think it's personal preference. There's no right or wrong, I think. I end up just increasing the types of trades I take. So I won't only take my highest win rate trades, I'll take some counter trends, I'll take some hedges and ordinary positions that I wouldn't take at the start of the year. But if I have a buffer, I can start to, you know, explore these, because I will bring my average win rate down and play the risk reward game. And through that, if you do it right, you can slowly increase your rate of return. The other side of the spectrum, which Umar has and a few others, Burned is another one that I asked, he said that no, I'd rather just take my A+ setups, but double down on them as the year goes through. What is your position on that in terms of types of trades where some trades are less likely, but they're still good trades, they're still profitable trades, but they're not the A+ setups?
I'm definitely on the other side of the spectrum. I like to find my A+ setups, but put more size on.
Okay.
So I'm more of a size up type of trader. I just found I don't do well when I take more trades. Some people can. For your system, you can take, maybe you're not just your A pluses, but your Bs, your B pluses, your C pluses. And once you have that cushion, you can do that and make that work for you. For me, for whatever reason in my 8 years, maybe it works on year 9. Maybe I try it out in year 10. We're not stuck to one thing as a trader. It just hasn't worked out for me. Mm-hmm. And so I found that once I have that cushion, once I'm feeling confident, I'm turning and burning, I'll put on more size to the setups I was taking, say, a month or 2 or 3 months ago, or yesterday for that matter. And I'll put on more size to them, put on a little more risk, and therefore, if it works out, get more return. Mm-hmm. But I definitely prefer sizing up.
Fair enough. The number one kind of problem I see in my DMs from traders is that, hey, Waqar, I'm profitable in my back testing. In the simulators, I make a lot of money, but I can't make it in the live market or through a prop firm. And that's a bridge that I think every trader has to cross, where like in the simulated emotionless environments, they're crushing it. And then the same strategy, apparently the same trades they take, and it just doesn't work out. So how did you bridge that gap?
This is something that I'm always told is controversial, but I just say it as, someone who wants to see people win, is I think that paper trading is a scam. I don't use the word scam lightly because it's thrown out left and right, but I don't think that any trader who is learning should ever paper trade beyond learning their platform. And the reason for that is just like you said, if you're paper trading trying to learn a system, you're going to get very confident using money that doesn't matter. No matter how many times you tell yourself that money is real in your head, like I'm going to pretend this is real, or I'm going to treat this like it's real. It's not the same as using your hard-earned money. It's not the same as using your money that you would pay rent with, or you would feed your dog with, or you would take your girlfriend out to dinner with. It's just not the same. So for me, I always tell traders that ask, I'm like, if you are having this problem, then cut the simulator, cut the trading. Instead, go to futures or options or equity and trade one share contract at a time. Sure, you're not going to make any money doing it, but guess what? You're also not going to lose any money doing it. You're not going to lose much money, I should say, or you're not going to make much money. Mm-hmm. And what that will do is, even if you're only trading one share or one contract of whatever instrument you're using, you're still going to be putting real money at risk, and that emotion is still going to slightly be there. Versus paper trading, it's just not at all. Now, what you do then is, after you get good at trading one share at a time, you move to 2. Maybe on the first of each month, you evaluate, how did I do with 2 shares? Did I have emotion? Is my P&L green? It might only be green 10 or 20 or $30, but is it green or is it red? Okay, then we move up to 3 shares. And we slowly move that up, so then you're not stuck on, all right, I've been on a simulator for 3 months, I think I'm ready to go in, I've made $100,000 in the sim, and then what happens to 99 out of 100 traders? They come in and they get wiped on real money. You see it in every industry, FX, options, futures, equity, you see it everywhere. So for me, the only way to avoid that is by using real money. Even if it's little to none, it's still real money, it's still risk, and it's still money that you worked hard for, and you build yourself up from there.
So building on from that, it seems like you want to be in that environment where emotions count, and you want to trade with a situation that, even if it's a small amount, is real, and it's not just a simulator or I would have entered there, and you just have all these voices in your head that convince yourself. So following on from that, psychology therefore becomes important, or it becomes the differentiator between simulated and live, whether it's a small or large account. So I want to hear your thoughts on the importance of psychology. Some traders swing to 90% of trading is psychology. Other traders say the opposite. So I just want to hear where you are on that spectrum.
It's funny because I've had a few long phone calls with Umar, and one moment that I always remember is, and this guy has a few more years of experience than I do and has obviously had massive success. And there was one thing I said to him that he was like, I've never really thought about it this way, which is I think the only time he's ever said that to me, because he knows everything about everything with trading, is I was like, I don't think trading is 90% psychology, because you can't build solid psychology on bad technicals. I don't care how good your psychology is. I don't even know what that means for a lot of traders. If you don't have a system and if you don't have technicals, you have no business or need to read any trading psychology book. Think about it. David Goggins, worldwide known for one of the most disciplined men on earth. Dude's ran like 100-mile races and was a Navy SEAL. Like, dude is a badass. If you put him in front of a trading screen, he's going to have no idea what in the heck he is doing. Maybe he's a trader on the side, but it's besides the point. Besides the point, you put a super disciplined person in front of a trading screen, they're going to lose money. Now you take the disciplined work ethic that person has. They learn a solid trading system. They learn their technicals. They get experience in those technicals, and then you apply the discipline part. Then the psychology becomes important. But without having a solid system, risk management, technicals, and experience in that system, psychology doesn't mean anything. So people often say, just go read Trading in the Zone, or go read Mental Game of Trading, or go read One Good Trade. There's hundreds of trading psychology books. Sad truth is, they're not going to do nothing for you if you don't have a good strategy or if you don't have an edge. So do I think that psychology is extremely important? Yes. But how important and when it's important is the question that you have to ask yourself. Yeah. And I think it becomes more important as time goes on as a trader. Say you have 1, 2, 3, 4, 5 years of experience. Well, by then, hopefully you have a system down, you have an edge down, you have a lot of experience, you have some confidence in yourself executing. But if you can't follow your risk management, if you can't stay consistent in what you're doing, if you can't follow your stop losses, well, then the psychology part comes in, dealing with losses comes in, and that's where you got to put in that deep work on the psychology and not just your system.
I think the key there is when, because psychology is make or break, as we've seen many people face. They get a prop firm account, they get funded and blow it the moment it's funded, but the evaluation, they were good because of the emotions of real money. But then also the technicals, if you don't have technicals, make or break. So it's more a case of layer the foundation of technicals and then build your psychology on top, and both are equally important. Now I want to rewind a little bit. So traders in the industry, they are a sponge for information. You were there, I were there, where there's no official curriculum, there's no official degree. So we just look from mentor to mentor, YouTube videos, podcasts, books, whatever we can, just to soak it all in. And a couple years in, most traders are very well versed. They know a lot about everything. They know a lot about candlestick patterns, breakout traders. They know all this information. And aside from analysis paralysis, when you have so much information, it's hard to decipher what a strategy can be and actually a trading plan and actually an edge, despite all the information, despite all the good mentors and so forth. So I want to kind of hear your thoughts on how you built from information an actual edge, and what were the key lessons in knowledge to application?
I think analysis paralysis is a massive problem for a lot of traders. And that's why, this might rile some people up, I think that ICT has obviously had a lot of success. I think that clearly has the platform he has, he's helped people. But that whole system seems to be very complicated by a lot of people. The more you complicate your trading, the less success you're going to have. So for me, it's learning all the different things, trial and error, and dialing it down to in as simple as possible system to follow. Because the more you know doesn't mean the more you make. You don't learn more and make more in a sense of trading. Now you can learn more, dial that in, and then make more. But just because you watch 100 YouTube videos a week does not mean you're going to make 100 times more money.
Yep.
So for me, it was a lot of trial and error. I tried the indicators. I don't use indicators at all, might I add. There's not a single indicator I use besides volume, which I don't consider an indicator. I mean, it technically is, but it's not. Anyway, I don't use EMAs, I don't use SMAs, I don't use MACD, I don't use RSI, none of that. I've tried it all, doesn't work for me, doesn't mean it doesn't work for the next person though. I tried the different algorithms, I tried, just about everything. And what I found after trial and error, signaling back to price action, is if I just have candlesticks on my chart and volume, I can very simply watch that and execute on it without thinking about 100 different things. So I think, circling back to your question, that's what traders need to do, is find something that works for them, or go through the trial and error phase of, watching, volume price analysis, ICT, indicator trading, whatever that may be. Find what resonates with them, because every trader is different too. You gotta realize that, Some people watching this might be nurses, they might be doctors, they might be football players, they might be construction workers, and your financial situation, your personal life situation, your time situation, all that is different, and that is going to affect your trading. So, I always like to say that trading is not one size fits all. And so you have to find what works for you, what fits with you, what you can become confident in, and then really dial that in.
Following on from that, you know that statement that is like every strategy works, every system works. Are you a believer in that?
No. I think it can. I think it can work. I don't think there's any strategy that is just destined to fail. Maybe there is, but I think that, again, with it not being one size fits all, that if you take the good, eliminate the bad, a lot of that comes from journaling and your data, right? You can make any system work for you. However, that being said, if your data states the system isn't working, it's time to change something. You can't just keep, you can lead a horse to water, but you can't make it drink, right? You can implement a strategy 100 times, but if the strategy don't work, it's time to change something. So that's how I think of it is, I think that with enough trial and error, you can make a system work for you, but you're going to have to, double down on the strengths and remove the weaknesses. You can't do that without data. You can't do that without journaling.
So now 8 years of being involved in the markets and learning and so forth, which is more than most guests that I've had, you're up there in the most experience, I want to say. What are the key lessons that you've learned in this journey?
I think the biggest lesson is that your wins don't define you, it's your losses. A lot of people focus on the wins, but something I always say is like, I don't care how much money you make. You can show me $100,000 day, that's cool. Let me see your losses. Because you can have $300,000 days in a row. That fourth day you lose 400 grand, don't matter, right? Big wins don't matter. It's how you protect the downside. If you protect the downside, the upside will come. Another one that has stuck with me is that, you can buy education, you can buy computers, you can buy trading softwares, you can't buy experience. And people hate that. When people come to me and they're like, JDun, like, I'd love to learn trading. Can I buy this or can I buy that? And, it'll make me profitable. And I'll be like, you probably got a few years of learning before you make any real money. And people just, in a very fast-paced society, people hate that. But it's the truth, And if you feed someone BS of like, oh man, you come, buy that guy's course or buy my course or buy his course, whatever, and you're going to make money in 3 months. Like, for one, it's just not true. And it's just not going to happen likely, or they might make money, but then they'll likely lose it. It's not the right path that someone who wants to seriously take this seriously and make money long term is going to follow. So I think that it's very important for new traders and any trader to know that it's very reasonable that this might take 2 or 3 or 4 years or 5 years or 6 years to master and to get really confident and with experience. Right. And big thing is, I found that a lot of people started around 2020, 2021. We had COVID across the world. People were stuck inside, nothing to do. Let's pick up trading. Well, just because you have been interested in trading for the past 3 years does not mean you have 3 years of trading experience. How you use your time is much more important than the actual time, because trader A has been trading for 3 years, picked up trading in 2021, has journaled maybe twice a week, spends an hour a day on the markets, treats it like a hobby, might have 3 years of experience, but trader B picked up trading in 2021. He's journaled every trade. He or she has journaled every trade. They spend 2, 3, 4 hours a day in the markets. They back test. They use a lot of trial and error techniques. Trader B in those 3 years is going to be much farther along than trader A because they used their time valuably. And a lot of people say that they've been trading for 1, 2, 3, 4 years, but they don't valuably use their time. Yep. And that's what's holding them back.
Now, to kind of wrap up the episode, we've spoken about your journey here, but also looking forward. Despite the fact that you've achieved a lot, you're still a young man with a long career ahead of you, let's say. What are kind of the goals you have, or let's say areas you want to improve, or milestones you want to hit?
In trading, I think that I like to stay away from profit goals, but I'd love to have a 7-figure year. If I follow my systems, if I follow my 8 years of experience and what I've learned, that will come. Maybe it's this year, maybe it's next year. I don't know, but that's a goal of mine. I would like to continue to better my system, to become better at my executions, better at my risk management. I think that as someone, all my life, I love improvement. I love growth, whether it's in trading, whether it's in business, whether it's in fitness. no matter what I'm doing, I just like to see growth. And so for me, growth used to come from my P&L in trading. I used to think, oh, if I make more money this next year, that's growing, which in a technical business sense, companies that make more money year after year are growing. Well, in trading for me, that's how much time do I have available? Am I following a system? Am I learning? And of course, the last one is like, am I sustainably making more money and improving myself as a trader? So that would be a big goal of mine, I'd say, is just to keep improving in every way, staying a student of the game, staying humble. And I know that 7-figure year is coming if I can do those things.
JDun, thank you for flying down, making this happen. And yeah, I think it was an epic episode.
Yeah, thank you. Thank you so much for having me, man. This is, you got an incredible platform going on. You've had some of, if not the best traders in the world on here, and can't wait to see where you guys keep going.
Boom. Thank you, bro.
Thank you.